A real estate investor buys a $2 million apartment building generating $200,000 in annual rental income. Through cost segregation, they claim $400,000 in first-year depreciation. Through bonus depreciation, they claim $300,000 more. Through Section 179 expensing on equipment, they claim another $100,000. Their total deductions in year 1 are $800,000 on a $2 million asset generating $200,000 in cash flow. They report a $600,000 loss for tax purposes while receiving $200,000 in cash flow. Over 5 years, they accumulate $1 million in cash flow while reporting $3 million in paper losses. Their effective tax rate on that income, 0. Meanwhile, an ordinary wage earner making $200,000 pays roughly $60,000 in taxes. The investor pays nothing. This is the hidden wealth building strategy that real estate professionals use but ordinary people never learn. The strategy isn't just depreciation, which everyone knows about. It's a combination of advanced tactics, cost segregation, bonus depreciation, Section 179 expensing, real estate professional status, entity structuring, and strategic timing. Together, these strategies create a mechanism where substantial real estate income is completely sheltered from taxation while the investor receives cash flow. This isn't tax evasion. It's not illegal. It's completely sanctioned by the tax code. The IRS explicitly allows these deductions, but most people don't know they exist. Real estate professionals and their CPAs use these strategies systematically. Ordinary real estate investors miss them entirely and pay far more in taxes than necessary. By the end of this video, you'll understand exactly what cost segregation is and how it works, what bonus depreciation is and why it's so powerful, what Section 179 expensing is and how it applies to real estate, what real estate professional status means and why it's transformative, and most importantly, how combining these strategies creates a wealth-building mechanism that's available to ordinary real estate investors but remains unknown to most. Before we go further, if you want to actually understand the advanced tax strategies that real estate professionals use systematically to reduce their tax burden to near zero while accumulating substantial wealth, this is exactly what this channel breaks down every single week. Subscribe now, because what I'm about to show you next is how real estate becomes the most powerful wealth-building tool available, not despite taxes, but through strategic tax optimization. Let's start with cost segregation, because understanding this strategy is the foundation for everything else. Cost segregation is a detailed analysis of a building's components, separating them into different depreciation categories based on their useful lives. Under the tax code, different property components depreciate over different time periods. Structural components like walls, roof, foundation depreciate over 27.5 years for residential property, but personal property components like appliances, fixtures, flooring, mechanical systems depreciate much faster, over 5, 7, or 15 years depending on the category. A cost segregation study, performed by specialized engineering and tax firms, breaks down the total building cost into component categories. Instead of depreciating the entire building at 27.5 years, you depreciate portions at shorter timelines. This accelerates the total deductions, especially in early years. Here's a concrete example. A $2 million apartment building might be broken down as follows by a cost segregation study. $750,000 in structural components depreciating over 27.5 years, roughly $27,000 annually. $1 million in personal property, appliances, fixtures, and mechanical systems depreciating over 5 to 7 years, roughly $140,000 to $200,000 annually in early years. $250,000 in land improvements depreciating over 15 years, roughly $17,000 annually. Instead of depreciating $2 million at 27.5 years, roughly $73,000 annually, you're depreciating components at different rates, totaling roughly $240,000 to $270,000 in depreciation in the first year. That's 3 to 4 times the normal depreciation deduction. The cost of a cost segregation study is typically $15,000 to $20,000 for a $2 million building. The annual tax savings from the accelerated depreciation easily justify this cost. A $30,000 additional deduction, taxed at 32% rough marginal tax rate for high earners, saves roughly $9,600 in taxes annually. The study pays for itself in 2 years and generates tax savings for decades. This is why sophisticated real estate investors always conduct cost segregation studies. Ordinary investors don't know about them or assume they're too expensive. The result is that sophisticated investors get dramatically lower tax bills on the same properties. Now let's talk about bonus depreciation, because this strategy accelerates deductions even further than cost segregation alone. Bonus depreciation is a tax code provision that allows you to deduct a large percentage of qualified property costs in the year the property is placed in service, rather than depreciating it over the useful life. Under current tax law, bonus depreciation allows 100% deduction of qualified property costs in the year placed in service. This means if a cost segregation study identifies $300,000 in qualified personal property and land improvements, you can deduct the entire $300,000 in year 1, not over multiple years. Combined with cost segregation, this creates enormous first-year deductions. A $2 million building might generate $300,000 to $400,000 in first-year depreciation from component depreciation plus an additional $300,000 from bonus depreciation, totaling $600,000 to $700,000 in year one deductions. This completely changes the tax picture. On $200,000 in rental income, $600,000 in deductions create a $400,000 tax loss that can be carried forward or, under certain circumstances which we'll discuss, used to offset other income. Bonus depreciation is currently available at 100%, but it phases down over time. By 2026, it phases to 80% and it continues declining. This creates urgency for real estate investors to complete acquisitions while 100% bonus depreciation is available. Sophisticated investors are timing real estate purchases specifically to capture 100% bonus depreciation before it phases out. They're completing acquisitions before year-end to capture deductions in the current year. Ordinary investors don't understand this timing dynamic and miss the opportunity. The wealth-building implication is enormous. An investor who structures acquisitions to maximize bonus depreciation generates vastly larger deductions than an investor who doesn't understand this strategy. Over a real estate career spanning decades, this difference compounds to millions in tax savings. Let's talk about Section 179 expensing, because this strategy provides additional deductions on specific property types. Section 179 is a tax code provision that allows immediate deduction of certain business property costs rather than depreciating them over time. For real estate, Section 179 applies to certain equipment and improvements but not to the building structure itself. Common Section 179 candidates in real estate include parking lot resurfacing, landscaping improvements, roof replacements, HVAC system replacements, flooring, and other specific property improvements. These can be immediately expensed in the year incurred rather than capitalized and depreciated. The Section 179 deduction limit is roughly $1.16 million for 2026, meaning you can expense up to $1.16 million in qualified property costs. For a property investor making substantial improvements or upgrading systems, this can generate $100,000 to $300,000 in immediate deductions. Combined with cost segregation and bonus depreciation, Section 179 adds another layer of deduction acceleration. A $2 million property with $300,000 in improvements might have $100,000 in Section 179 expensing, plus $300,000 in bonus depreciation on other components, plus regular depreciation on the remaining structure. The cumulative effect is that year one deductions on a $2 million building can easily exceed $1 million, completely sheltering the building's income from taxation. Section 179 is strategically used by real estate professionals who time improvements specifically to maximize immediate deductions. Rather than spreading improvements over multiple years, they concentrate improvements in single years to maximize Section 179 expensing in those years. Ordinary investors don't strategically plan improvements to maximize tax deductions. They make improvements as needed. Sophisticated investors plan improvements strategically around tax deduction optimization. Now let's talk about real estate professional status, because this classification fundamentally changes how deductions are treated. Real estate professional status is a special designation under the tax code that allows certain people engaged in real estate business to deduct passive losses against active income without the normal passive loss limitations. Normally, passive losses from rental real estate or other passive business activities can only offset passive income, not active income like wages. A real estate investor with a $600,000 paper loss from depreciation can't use that loss to offset their W-2 wages or active business income. But if someone qualifies as a real estate professional, this limitation disappears. Real estate professionals can use unlimited passive losses to offset any income. This transforms the value of depreciation deductions. To qualify as a real estate professional, you must meet two tests. First, more than half your working hours must be devoted to real estate activities. Second, you must have performed substantial personal services in the real estate business during the year. These tests are subjective and have been subject to IRS challenges, but many real estate investors qualify. A real estate professional with a $600,000 loss from depreciation can use that loss to offset $200,000 in W-2 wages, $200,000 in business income, $200,000 in investment income, creating a $600,000 reduction in taxable income. At a 32% marginal tax rate, that's $192,000 in tax savings. For someone with substantial real estate holdings and active real estate business involvement, real estate professional status is transformative. It changes passive losses from essentially worthless since they can't offset anything to extremely valuable since they offset all income. Sophisticated real estate investors structure their activities and their documentation specifically to qualify for real estate professional status. They track time spent on real estate activities. They maintain documentation of personal services rendered. They position themselves to claim this status. Ordinary investors often don't realize this status exists or don't think they qualify. They miss the opportunity entirely. Let's talk about opportunity zones, because this strategy provides tax-free capital gains zones for investors willing to hold real estate in designated economically distressed areas. Opportunity zones are geographic areas designated by the federal government as economically distressed. The tax code provides special benefits for investors who put capital into businesses or real estate in these zones. The core benefit is that capital gains tax is deferred indefinitely if you invest in an opportunity zone fund. If you have capital gains of $1 million, you can invest those gains in a qualified opportunity fund and defer capital gains taxes indefinitely. Over time, any appreciation within the opportunity zone fund is tax-free. Additionally, if you hold the investment for at least 10 years, the capital gains tax basis is stepped up to the current market value, completely eliminating capital gains tax on the appreciation that occurred during the 10-year holding period. This creates a powerful strategy for real estate investors with capital gains. Sell a property with substantial gains, invest those gains in an opportunity zone fund that purchases real estate in designated areas, hold for 10 years, and the original gains and all subsequent appreciation are completely tax-free. For a real estate investor with $10 million in capital gains, an opportunity zone strategy could defer taxes indefinitely and potentially eliminate taxes on those gains through the basis step-up mechanism. Opportunity zones are geographically dispersed across the country in economically distressed areas. Some are in Rust Belt cities, some are in economically disadvantaged rural areas. The economic viability of opportunity zone investments varies significantly by geography. Sophisticated real estate investors use opportunity zones as part of their overall tax strategy, particularly when they have capital gains to deploy. Ordinary investors don't know about this strategy and miss the opportunity entirely. And now let's talk about Delaware statutory trusts and how they enable advanced real estate strategies. A Delaware statutory trust is a legal entity used primarily for 1031 exchanges, but it has advantages beyond just tax deferral. DSTs allow passive investors to pool capital with other investors to purchase larger properties that individual investors couldn't afford alone. More importantly for our purposes, DSTs enable real estate aggregation strategies where multiple properties are held in different DSTs or entities, each optimizing tax deductions independently. Rather than holding multiple properties in a single entity, which complicates deduction tracking, investors can hold properties in separate DSTs, each with its own depreciation schedule, cost segregation study, and tax strategy. This enables sophisticated investors to segregate deductions by property type. A multifamily property might be held in one DST optimizing residential depreciation. An office building might be held in another DST optimizing commercial depreciation. Each is treated independently for tax purposes, maximizing total deductions. DSTs also enable 1031 exchanges where the investor doesn't have to actively manage the subsequent property. The DST manages the property, collects rent, pays expenses, and distributes cash flow to investors. This allows passive investors to defer capital gains taxes through 1031 exchanges without the burden of active property management. For sophisticated real estate investors, DSTs provide a structural framework for tax optimization that ordinary individual ownership doesn't provide. Let's talk about self-directed IRAs and solo 401ks for real estate investing, because these strategies shelter real estate income from taxation entirely. A self-directed IRA is an individual retirement account where the account owner has control over investments. Most people use IRAs for stocks and bonds, but IRAs can also invest in real estate. An investor can use self-directed IRA funds to purchase real estate. The property is held inside the IRA. Rental income generated by the property accumulates tax-free inside the IRA. No annual taxation of the rental income. No capital gains tax when the property appreciates. All returns accumulate tax-free until you withdraw funds from the IRA. The contribution limits are lower than regular investment accounts, roughly $6,500 annually for IRAs, but the tax sheltering is complete while funds remain in the account. A solo 401k is an even more powerful vehicle for self-employed real estate professionals. Solo 401ks have much higher contribution limits, up to $69,000 annually for 2026. Additionally, solo 401ks allow loans against the account balance, enabling the investor to access capital without triggering tax consequences. A real estate professional with a solo 401k can potentially contribute $60,000 annually, invest those funds in real estate held inside the 401k, and receive completely tax-free returns on that investment. Over a career spanning decades, this creates enormous tax-free wealth accumulation. Most ordinary real estate investors don't know self-directed IRAs or solo 401ks exist. They don't use these vehicles. Sophisticated investors use them systematically to shelter real estate income from taxation. Now let's talk about entity structuring and how choosing the right business entity for real estate optimizes tax outcomes. A real estate investor could hold properties as a sole proprietor, an S corporation, an LLC, a partnership, or a trust. Each structure has different tax implications. An S corporation for real estate rental activities provides pass-through taxation but enables the owner to take reasonable distributions as salary subject to self-employment tax and distribution distributions as profit not subject to self-employment tax. By structuring income as salary versus distribution, an owner can optimize the overall tax burden. An LLC is generally treated as a partnership for tax purposes if multi-member, or as sole proprietor for single member. This provides liability protection but pass-through taxation. A trust can provide liability protection, privacy, and potentially tax optimization depending on structure. Sophisticated investors structure each property in different entities optimized for that property's circumstances. A high-income generating property might be in an entity structured to minimize self-employment tax. A property with substantial deductions might be in an entity structured to maximize loss pass-through to offset other income. Ordinary investors typically use simple structures and miss the optimization opportunities that entity selection provides. The tax implications of entity choice can amount to tens of thousands annually for substantial real estate portfolios. Over a career, this adds up to hundreds of thousands in tax optimization. Let's talk about the repair versus capitalization distinction and how aggressive categorization generates tax savings. When a real estate owner spends money on a property, the question arises, is this a deductible repair or a capitalized improvement? Repairs are deductible in the year incurred. Improvements must be capitalized and depreciated over the useful life. The distinction can save or cost thousands annually depending on how items are categorized. The IRS has detailed guidance on the distinction. A repair maintains the property in its current condition. An improvement enhances the property or extends its life substantially. But the guidance is subjective and open to interpretation. Sophisticated real estate investors and their tax advisors aggressively categorize items as repairs rather than improvements whenever possible. A new roof can be argued as repair and maintenance rather than capital improvement. A new parking lot can be categorized as repair. HVAC system replacement can be repair rather than improvement. Each categorization decision saves months or years of depreciation time, generating immediate deductions rather than spread out deductions. The cumulative effect of aggressive categorization across dozens of decisions annually can amount to thousands in additional deductions. Ordinary investors and their less sophisticated tax preparers don't aggressively pursue these categorization strategies. They either properly categorize everything or don't think about it at all. The wealth building implication is that sophisticated investors get lower tax bills through strategic categorization of expenses. Now let's talk about installment sales and how they enable capital gains deferral for real estate. An installment sale is a property sale where the seller receives payments over multiple years rather than a lump sum at closing. Under tax law, capital gains tax is deferred over the years in which payments are received rather than all at once in the year of sale. For a real estate investor who sells a property with substantial capital gains, an installment sale enables the seller to spread the gain recognition over multiple years, potentially keeping each year's taxable gain below thresholds that trigger higher tax brackets or alternative minimum tax. For example, a property sale with $1 million in capital gains recognized all at once might trigger a 20% capital gains tax, $192,000 in federal tax at high income levels. If the same gain is spread over 5 years through an installment sale, each year's $200,000 in gain receives more favorable tax treatment, saving substantial taxes through bracket management. Sophisticated investors use installment sales strategically to spread capital gains recognition over time, optimizing the tax burden. Ordinary sellers often do lump sum sales without considering installment alternatives. The tax savings from installment sales can amount to tens of thousands for substantial transactions. Let's talk about the qualified business income deduction and how it benefits real estate professionals. The qualified business income deduction allows pass-through business owners, including real estate professionals, to deduct up to 20% of qualified business income from their taxable income, subject to phase-out limitations. For a real estate professional with $500,000 in qualified business income from rental activities, a 20% deduction equals $100,000 in deductible income. At a 32% tax rate, that's $32,000 in tax savings. This deduction is available to real estate professionals if they meet certain income and entity structure requirements. It can be combined with other deductions to create substantial tax reduction. Ordinary real estate investors don't understand this deduction or don't structure their businesses to claim it. Sophisticated investors ensure their structure and documentation supports QBI deduction claims. Now let's talk about how these strategies combine to create the powerful wealth building mechanism. Consider a real estate professional investor with the following situation. They purchase a $2 million apartment building generating $200,000 in annual rental income. They conduct a cost segregation study identifying $400,000 in accelerated depreciation. They identify $300,000 in bonus depreciation on personal property and improvements. They expense $100,000 in Section 179 on equipment. They claim $100,000 in aggressive categorization of repairs rather than improvements. Total first-year deductions, $1 million. Taxable income, $200,000 in rental income minus $1 million in deductions equals negative $800,000. They report an $800,000 loss for tax purposes. They qualify qualify as a real estate professional, so they can use that $800,000 in losses to offset their W-2 wages. Suppose $200,000 in business income, suppose $300,000. That's $500,000 in income offset, leaving $300,000 in losses to carry forward to offset future income. Year 1 tax result: they received $200,000 in cash flow and paid approximately $0 in taxes on that income because of deductions. They carried forward $300,000 in losses to shelter future years' income. Over 5 years, they accumulate $1 million in cash flow, pay minimal taxes, probably under $50,000 total on 5 years of cash flow because losses continue to shelter income, and the property has appreciated to $2.5 million. Meanwhile, an ordinary wage earner making $200,000 pays roughly $60,000 in taxes annually. Over 5 years, that's $300,000 in taxes on $500,000 in cumulative income. The real estate investor paid virtually nothing in taxes on $1 million in cumulative cash flow. This is the wealth building mechanism that separates real estate professionals from ordinary people. Let's talk about what's required to access these strategies and what prevents ordinary investors from using them. These strategies are legal and sanctioned by the tax code. They're not loopholes, they're not tax evasion, but accessing them requires knowledge, sophistication, and often professional advice. First, you need to understand that these strategies exist. Most ordinary real estate investors don't know about cost segregation, bonus depreciation, Section 179, or real estate professional status. They don't read tax code sections. They don't track time spent on real estate activities to qualify for professional status. Second, you need to implement them correctly. A cost segregation study costs $15,000 to $20,000 but saves far more in taxes. Ordinary investors see the cost and skip the study. Sophisticated investors see the cost and recognize it as a trivial investment that generates enormous returns. Third, you need professional help. Tax CPAs who specialize in real estate understand these strategies. Real estate accountants who work with property investors understand them. Ordinary accountants who prepare standard 1040 tax returns don't know about cost segregation or real estate professional status. Fourth, you need to structure your business correctly to capture these deductions. Holding properties in the wrong entity type, failing to maintain documentation of real estate professional time, failing to separate properties into different entities, these mistakes prevent deductions from being claimed. Sophisticated real estate professionals systematically access all these strategies. They work with specialized tax advisors. They structure entities correctly. They time acquisitions strategically. They accumulate substantial wealth with minimal tax burden. Ordinary real estate investors miss these opportunities entirely and pay far more in taxes than necessary. If understanding the advanced tax strategies that real estate professionals use systematically to reduce their tax burden to near zero while accumulating substantial wealth is useful to you, that's exactly what this channel is built around every single week. The gap between sophisticated real estate investors and ordinary investors is enormous, and much of that gap is created by tax strategies that ordinary people don't know exist. Subscribing means you won't miss the next breakdown of wealth building strategies, tax optimization, and how the most successful real estate professionals structure their businesses and investments to maximize after-tax returns. More importantly, you're getting someone who's specifically focused on understanding financial mechanisms and explaining them clearly. Before you go, drop a comment and tell me honestly, if you own rental real estate, have you conducted a cost segregation study, claimed real estate professional status, or used any of these advanced strategies? Or are you just claiming standard depreciation and accepting a normal tax burden? Your answer tells you a lot about whether you're optimizing your real estate investments or leaving hundreds of thousands in tax savings on the table over your lifetime. And just to be clear, this content is for educational and informational purposes only and does not constitute financial, investment, tax, or legal advice. I am not a licensed financial advisor, tax attorney, or investment professional. Always do your own research and consult with a qualified professional, a tax professional or CPA who specializes in real estate before implementing any of these strategies. Tax laws change frequently and have complex requirements. A professional can ensure you meet all requirements and document everything properly. Past performance is not indicative of future results. All investments carry risk, including potential loss of principal. See you in the next one.